about the medium term and long term for the markets? That's something we'll discuss with Trideep Bhattacharya, President and CIO Equities at Edelweiss Mutual Fund. Trideep, hi, good to be speaking with you. Do you think the bulk of the problem and the correction is over? Or do you see still some fraud or still some time-wise correction which is left?
So, thank you very much for having me on your show. And good afternoon to all viewers. I would say we have three issues. Two are unknowables, and one a cause for persistent worry. The unknowns are Trump and his policies and the budget that lies in front of us. Those unknowables will be kind of, by and large, understood in a week from now. What we will be left with is basically the lingering earnings worry. And my sense is that's something to kind of, take a cognizance of. Since the beginning of fiscal year, we have seen an earnings cut of close to 10%. And broadly speaking, if you look at market corrections, a little bit here and there, but broadly it has been mirroring the earnings correction as well. So I think because the market declines are associated with earnings fall, we think that till the time earnings make a comeback, markets will actually be will take a bit of a breather. It will not be immediate. And hence, we think that this time the correction might linger on a little bit longer. But I don't think this is more than a 6 or 7 month problem. I think by the time we hit about June quarter of next year, we would see earnings starting to come back. And that's when we would look the markets to kind of gradually recover. So maybe not an immediate respite, barring trading rallies, but not very long dated correction either.
Good afternoon, Trideep. This is Srishti also joining in. But in this market correction, we have seen the mid caps and the small end of the market falling more. So just wanted to get a sense that how are you placing your bets within the space after the recent fall? Is this a time to bet big on this particular space, or would you rather look forward to stick to the large caps in this uncertain environment?
No, I think we are on the hunt even for mid and small caps, except that we are doing it in a more gradual manner rather than kind of going all bets in. As I said earlier, that this correction would actually take a bit longer to sort of come back because this is accompanied by earnings decline. So we have to see the earnings declines through, and then we will see acha din for markets overall. And hence, keeping that in mind, we have our hunting hat on with regards to not only mid and small cap, but also large caps. But we are much more gradual in nature rather than going all bets in. We would like to see some of these unknowables out of the way. And wherever earnings are relatively stronger, we are gradually increasing our bets all across between large, mid, and small.
You are agnostic between the market capitalization bandwidth, but within sectors, where does the preference lie? Of late, where have you deployed more funds?
Yeah. So I think in this weakness, we have added to some of the real estate names. We think that in the context of if we do get a rate cuts as we go through the year, they would actually stand to benefit from the same. We also think that areas like NBFCs, where balance sheet is strong and they have strong franchise, that's another area both in large and mid cap space, where we have kind of, we feel that earnings are likely to be resilient, valuations are still reasonable. And again, if there's a rate cut as we go through the year, they would stand to benefit from the same. And finally, selectively on the consumption side, we think consumption could be the dark horse of calendar year 25. As we get some better prices, we are nibbling our way in. Starting position is, of course, underweight in consumption. But we think as the year goes by, the prices look to me incrementally interesting on this space.
All right, but Trideep, one such hope or one such expectation in the market was that in the second half of this particular fiscal year, the capex was expected to pick up. The budget is just around the corner. Just wanted to get your sense on that. Were you also hoping for the capex to pick up in the recent while? And also during this period, the PSUs have taken a backseat. Nobody is actually talking about that. So are you on a hunt to find some value within the PSU basket as well?
So to answer your first question, yes, I am disappointed with the pace of comeback of capex in the back half of fiscal year 25. I mean, to put numbers here, we had budgeted for 11.5 lakh crores, and it seems even if we go full throttle from here, we'll end up doing somewhere between 8 to 9 lakh crore and nothing more this year. Partly driven by lack of decision making, driven by elections, but even subsequent to elections, the pickup has been a little bit slower than what we would have budgeted for. But in the context of government, they think in a 5-year term. So, just because it didn't happen in in 6-9 months, not all is lost. So I'm hopeful that in the upcoming budget, as Honorable Finance Minister talks about, the future growth plans, capex forms an important part of the agenda, and I'm hopeful that whatever spend has not happened this year will make a comeback in the subsequent year. So I'm disappointed, but we haven't lost heart on that one. Now, with regards to kind of, some of these areas within capital goods also ran up a bit too much, hence the valuations were on the higher side. Which needed to correct, and that's the other part which is kind of coming through in this result season as well. So it's a good bit of a reconciling with fundamentals that has happened over the last 6-9 months. I think it will make a comeback, but with a bit of a lag.
When that comeback does really happen, but yes, this year definitely the government has fallen much shorter on expectations with respect to their capex announcements. Trideep, just coming back to the point wherein you said you're still positive on real estate, given the fact that the stocks have run up quite a bit in the last couple of years, perhaps even ahead of fundamentals, and there are initial reports talking about how that sector might have just plateaued out a bit in terms of the inventory building up or the registration slowing down, at least in certain segments, wouldn't it be better to play through the building material side, because that is where the comfort of valuation lies?
A good spot. So I think when we talk about real estate, we talk about direct plays as well as indirect plays. And clearly the direct plays, which are the builders, have done quite well over the last few years. I would argue that they have the runway is still ahead of them. They would do well as well. But going forward, maybe the ancillary sectors like the building materials, which haven't done as well, will actually continue to will actually kind of start to improve. I do see a bit of a further 6-9 months gap, after which that trend starts to pick up, because we think the initial stages of the project completion is not yet fully done. So in sync with what you are saying, but it might take a little more time. In the meantime, builders might continue to do well, particularly kind of, if the rate cuts happen, the relative attractiveness of real estate kind of tends to go up a little bit, and they would also stand to benefit from the same. So at the moment, from builders' perspective, we are a little more selective, holding on to the ones which have a strong launch pipeline, and gradually building our positions in building materials or ancillary sectors is the way we are approaching this sector.
All right, but Trideep, in this recent market volatility, what we have seen is that even a bit of a disappointment, and the stocks were tanking way below than the expectation. And some of these high PE stocks were actually fighting more. Case in point being some of these new age tech companies from the likes of Paytm, Zomato, Dixon, where the growth numbers were actually very strong. The predictions were strong, but these were high PE counters. But given the recent correction, do you believe that this is once again maybe a time to look at these particular stocks or sectors where the growth outlook is very strong, or maybe you think that for some time now, for quite some time, one should just avoid this completely and maybe try to build an exposure later?
So while I can't comment on specifics, I do acknowledge that some pockets of growth, while the growth has been strong, the valuations, which is what I said earlier as well, valuations really kind of had shot up over the last couple of years, and we have seen a bit of a valuation reset in some of those pockets over the last few months. The way we are approaching this is, as long as we are getting an earnings premium versus broader market in those segments, in those pockets, we are holding on to our bets. even though there is a bit of a valuation correction. We had taken some profits earlier, but we are not completely exiting. We believe that this valuation reset had to happen, but after the valuation reset, they are still good to go, because on a relative basis, earnings growth here is at a meaningful premium to the broader market. But in those areas where we are seeing earnings softening, there we are kind of taking a dim view and exiting those areas, because there clearly kind of the downside could be quite meaningful. So in other words, particularly for high growth stocks, we are a little more selective than what we were earlier. This is the process that we have done over the last 6 months, not just immediately, and we'll continue to remain that way.
Valuations, of course, one of the top criteria. Thanks so much, Trideep, for making time and speaking with us. News at the bottom of the screen that the recovery rally continues in the market. Let's see whether